the monetary unit sampling. And, we'll see. Okay, so I think let's jump into the chapter 5 handout, evidence. And evidence, of course, as we talked about last time, is what we need to form an opinion. So, okay, and of all these documents, generally the stuff that comes from the third party is held by the third party. This is the best evidence. Talk a little bit about that. Bill of lading is an important one. Okay, management representation letter. At the end of the audit, the client's chief executive officer and chief financial officer we handed a management letter to sign, and the management letter includes all the important information and all that the auditors have relied upon during the audit. There's a big list of stuff that goes in here, but and basically some of the things that'll be in there are things like that they were given all information was given to the auditors. The financial statements are fairly presented. Oops. Things like that, things that are relied upon. All board of director minutes are given. So there's a lot of things like this in there that they're basically the things that you relied upon when doing the audit. Okay. So the management letter, what's it for? It does not replace any audit evidence or audit steps. So it doesn't like, oh, well, I know, let's have them sign this letter and then we'll be off the hook. No, you have to do your audit as if you are, as if you have to have what they call professional skepticism. you know, whatever they tell you, you have professional skepticism that you have to check and make sure that everything that they're telling you, you'll back that up, corroborate that with evidence. But what the management letter does more than anything is it commits management, the chief financial officer and the CEO, to take responsibility for the financial statements. They're signing a statement saying that all this stuff is true. So all those things that you relied on during the audit, you put that in that management letter, and management will sign it. Again, it does not replace audit evidence, but it is considered part of audit evidence because it sort of reminds them, of their responsibility. Well, the question comes about, well, what if they don't sign it? You hand them a letter and they won't sign it. Or maybe one of them won't sign it. What happens if the chief financial officer says, look, I can't sign this? And that does happen sometimes. What do you do? A lot of times that's enough to give a disclaimer of an opinion. Because if they're not signing it, the idea is that there must be a reason why they're not signing it. If they're not telling you the financial statements are fairly presented and they gave you all the information and all that kind of stuff. If they don't sign it, that is usually a red flag, as to why aren't you signing it, that sort of thing. So let me put that in here. The CEO or CFO refuses to sign it. I should say may. They may, unless there's some reason why they can come up with as to why they're not signing it. So, but generally speaking, it's a big deal. It's definitely a scope limitation if they refuse to sign it. Question that. So that's a management representation letter, and again, it just says that there's quite a bit of stuff in there, but generally speaking, it's a normal procedure. And while it doesn't replace any other evidence that we're getting, what it does do is it kind of commits management to the responsibility of the financial statements. Okay, a lawyer letter. A lawyer letter. Let me get how he phrases. Under US rules, auditors are required to get a letter from the lawyer. This letter will contain information on material litigation. Now, the client must give the lawyer permission to do this. And this brings up a kind of a strange situation, and this is the only time that it really happens. Materiality for the letter, I should say. Okay, a lot here. Let me go over it. Okay, US auditors are required to get a lawyer letter. And this goes to our legal system. In the United States, legal systems, our legal system is it's almost like Wild West kind of it. You could have tens of millions of dollars worth of liability, and you kind of don't know what it, a lot of times you don't know what the outcome's going to be. Excuse me. For these other countries, they generally don't have that. If they a lot of their stuff is kind of by, they have like a law. Okay, if someone is injured in the accident, this is what they get. If somebody is killed in an accident, this is what they get. All these kind of liabilities are generally kind of worked out. And lawyers in other countries are almost like kind of like accountants in this country, that you go to the books and you go, okay, well, this is, if this is 20%, then it's this, if it's 50%, it's that, or whatever. And so they don't have these giant lawsuits hanging out there, whereas the United States, they do. So in the United States, you have to get a lawyer letter. And the reason is because some of these lawsuits, I mean, they could be bigger than the entire company. One lawsuit could bankrupt the company. Okay. Now here's the problem, though. We're looking at things that are material, and the lawyer, the client must give permission. The materiality for the letter is usually discussed with the client. Now, this is unusual. You generally do not discuss the materiality with the client for obvious reasons. If you tell your client that materiality is 230,000, well, that just tells them that they can cook the books for 220,000 or whatever. So you don't discuss materiality with the client. You tell them that you're looking for material misstatements, but you generally don't tell them what the dollar amount is. But now when they go to their lawyer, their lawyer is going to ask, well, what's material? Is $200,000 material, or is 300, or is 3 million? What's material? So you're going to discuss with your client what's material. Most likely, you're going to pick a number that's lower than your materiality as far as the financial statements you're looking at. But that's one of I think that's the only time I can think about that you actually discuss materiality with the client. Generally, you don't put a dollar amount on it, but a lot of times the lawyers will ask, well, what's the dollar amount? What am I looking for here? Okay. External confirmations. I'm gonna go on the second page here. Confirmations. We'll talk about this in a second. US standard for confirmations, they are required. For accounts receivable. International confirmations. Not required. So US requires them, international standards do not. And the US standards are required unless there's a really good reason why. For instance, if they're not material, that they may not be necessary. If you hardly have any accounts receivable that are, on your books, they would be required. There's also, I was involved with kind of an unusual one, and that is that we had an engine plant when I worked for Navistar that made diesel engines for Ford. Now, we made the engines, but virtually all these engines, I think 95, 96% of them went to Ford. And the other 4 or 5% we sold to boat manufacturers and all these other places. So anyway, literally 95% of it was the Ford. So if you're auditing that place, for a financial audit, well, it really does, the only one that is material is going to be the Ford account. So that's probably the only one you're really going to look at. But generally speaking, you have to have a really good reason why, if you don't do the accounts receivable confirmations. And again, usually it comes down to them not being material. If you have an account that's clearly not material, you're not required to do it. But so accounts receivable confirmations are required by US standards. They're not required by international standards. That doesn't mean that they don't encourage it. It just means that they're not required. And there are other ways of getting this information, rather than just confirmations. Okay. Negative confirmations. I should actually do positive ones first. I don't like the order I put these in. Positive confirmations. Okay, so positive confirmations. Positive confirmations must all be returned regardless of any discrepancy. So if 100 positive confirmations are sent out, then 100 confirmations must be returned. And these confirmations are simply letters that go out so they're letters that go out to the client's customers. So let's say we're auditing IBM. IBM has a bunch of customers and they have all these accounts receivable on books. Now, notice that the accounts receivable, the documents that we have for for accounts receivable, the documents that we have from IBM are going to be the worst documents. The bill of lading won't be, but the rest of these are going to be the worst documents. So we want to take these worst documents and we're going to send them out to the actual customers of IBM and say, okay, this is what IBM says you owe. Do you really owe this? Yes or no? So at the end of the year, do you owe whatever, $20,000? At the end of the year, do you owe this? And they'll send it back saying, yes, we owe that much on December 31st. Or they'll say, no, we don't owe that, we owe this, or whatever their explanation is. So that's a positive confirmation that they'll all send back, they'll send all of them back. So if they say, yeah, this is right, they'll send it back. And if they say, no, this isn't right, they'll still send it back. And you send out 100 of them and you get back 91. And then you get on the phone and you call them up and they go, oh yeah, it's right here. Can you send it in? Oh, sure, sure. And they send it back in and then you get up to 97 and then you finally you get down to the last couple of ones and you call them up and you say, look, do you have a fax machine? Okay, go over to the fax machine and fax this to you. While we're still on the phone, fax this over to this number. So finally you get all 100 of them in. So that is a positive confirmation. Now, negative confirmation says, well, look, the ones that are okay, we really don't, we don't care about those, but those aren't the interesting ones. The ones that are interesting is when someone says, no, this amount isn't right, because that could be a problem with, the client's books. So the negative confirmations are a little bit different. They say, okay, only if there is a problem do you send it back. So you'll say right on there, if this amount is correct, please disregard this notice. If this amount isn't correct, please indicate the corrections necessary and send it back. So negative confirmations, they're only returned if they are bad. So let's put that up here. So negative confirmations are only returned if there's a discrepancy. Now, what do you think would be a problem with the negative confirmations? There actually is an inherent problem with these negative confirmations. What can you see being a problem with a negative confirmation? They're only returned if there's a discrepancy. So you put right on the confirmation that you send out that, look, if there's no problem, disregard this. If there is a problem, tell us what the problem is and return it. There is a problem with negative confirmations. Anyone? Hey, are you guys sleeping?
I guess we cannot confirm that there is with other accounts they don't respond. We cannot confirm that they're good and they're accurate.
That's exactly right. You don't know if you don't know what happened to the confirmation. First of all, you don't even know if they got it. I mean, maybe it went to the wrong, they delivered to the wrong address or whatever. Delivered to the company, someone didn't know what it was, threw it in the garbage, or someone opens it up and goes, oh, this is ridiculous, this is stupid, this is all wrong, throws it in the garbage. You don't know what happened with that. So the negative confirmations aren't as good as the positive ones. So you may
How
say,
do we know if it's a negative or positive? Is it going to say on the letter?
it'll say on the letter, yeah. If it's a negative one, it'll say don't send this back unless there's a problem.
Okay.
The positive one says, hey, whether there's a problem or not, send it back. If it's okay, circle okay and send it back. If it's not okay, put the correction in, send it back. And the negative ones, we don't call around to get them all back in because, if everything's okay, we tell them, forget it, disregard this notice. So the positive ones all come back. The negative ones only come back if there's a problem. Now, the negative ones are not as good because you're not getting all of them back. You don't know what the response is from everybody. And you don't know whether it went to the right person. You don't know whether they considered it. You don't know whether, and they may just be so frustrated with your client that they don't want to answer it. You don't know why exactly they may not. So you really can't get it's not as good of evidence, basically. And so here is kind of the a couple things on this. You might say, well, okay, why do we even have the negative confirmations, right? They're not as good. Well, here's why. Suppose the auditors would be equally satisfied with either the following. Oops, I should say cost each. I'm sorry, yeah. Formatting problem. And that is we have negative confirmations. Now notice we have a whole bunch more negative confirmations because it's not as good of evidence as positive ones. Right? So where we'd be happy with 100 positive ones, the negative ones will be happy with 500 of those, much more. And the cost each is $3. So if we multiply these out, you can see why we might 1,500. Go with the negative ones. And this is another, this is kind of another lesson in evidence. And that is auditors may not always obtain the best evidence. It may be too expensive. So auditors may not always get the best evidence. And I know it sounds funny, but sometimes, if you're looking at this situation, that if you're just as happy with 500 of the negative ones, the cost is less. And remember, you're also, one of the things about the cost of audits is generally you figure out the cost of an audit, you tack on some extra so that you make money on the audit. A part of this is that you are actually spending the client's money. So it really is also to the benefit of the client sometimes that you don't get the best evidence. It's simply too expensive to get the best evidence. Okay, now confirmations. There's one more twist to it that I want to talk about. And that is, when do we use these? Negative confirmations are generally used when there are many accounts and low dollar value. So if they have many accounts and low dollar value, we will use the negative confirmations. And the positive confirmations are just the opposite. When there are few accounts and they are high dollar value. Oops. And I'm going to make this green. Okay, so negative confirmations are when there's many accounts and low dollar value. So, and the idea being, look, if somebody doesn't send it back in, these are probably not material anyways, these are low dollar amounts. So that if somebody were to not send one in, or even a few people didn't send one in, they probably wouldn't make that too much of a difference because they're low dollar values. And because they're low dollar values, if they're misstated, it's probably not that big of a deal. At least for individually for those accounts. Positive confirmations are when they're high dollar values. So each one of these accounts may be material. You know, if these accounts are material, you know, if each of these accounts is material, you're going to want to get those back. So, you know, if these accounts here are, you know, under $200, okay, if one doesn't show up, that, you know, that's not that big a deal. If these are $200,000 accounts, each one of those accounts might be material and you want to get it back. You want to make sure that these are, you know, any one of those might be a material misstatement. So the kind of evidence you're looking for may also dictate which one of these you use. Okay, forget. Working papers. The working papers are the auditor's evidence to support their opinion. Working papers, sometimes called work papers. And those are to support your opinion, and you kind of set them up almost like as if you're going into court. Because if there's a problem with the audit, that, you know, that very well may be where you end up. So the working papers are the auditor's evidence to support their opinion. You know, so that when you go into court, you can say, well, we did this, we did that, we got all this evidence, and that you have this backing to show what you did. You know, and evidence that you know, that you made the effort, that was a reasonable effort to get the all the information you needed. Okay. Ownership of the working papers. The auditors own the working papers. Yeah, the client does not have a right to the working papers. And part of the reason why you do that too is that, you know, people say, well, gee, I paid for this audit, you know, okay, we're paying, you know, all this money for this audit. I want to see the working papers. Well, you can't. It's the auditor's evidence. And well, you might give information, like if there's a misstatement of an account or something like that, you'll get the information to the client that they need to make the correction. You do not give them access to the working papers. They don't need to know what method you use for, you know, you don't want them to know what method you use for sampling. You don't want them to know what method you use for what you use for materiality. All these things are judgment calls, and all these things are for the auditor to make a judgment about it. What the client is buying is not those work papers, they're buying the opinion. You know, they need an opinion, and usually it's for financing of some sort, or legal reason for getting the audit, but they are not buying the work papers. They're buying the opinion, and how they get to that. Not only that, the work papers a lot of times will have information about other people, people in the company that may not be, that should not be shared with the client. You do background checks on people, and there might be things that come up that have nothing to do with, someone wanting the information. But you have them in the audit work papers because, you might have information on somebody that's something happened in the past and that sort of thing. So there's you don't share those with, now you will, like say, if there's a problem, you will let the client know what the problem is, how you came up with it and all that kind of stuff, but you're not going to actually share the work papers. Okay. Confidential nature of the work papers. Auditor has a responsibility to their client not to disclose. Oops. I just say fiduciary. So even though the auditor owns the work papers, you cannot take those work papers and post them on the internet or something. Oops. So there are confidential information on the client, and you do not share that. However, the working papers to a court presented a valid I know I'm going to get this wrong. Yep. There we go. The valid subpoena. Okay, now it has to be a valid subpoena. And a valid subpoena means that a court has said, we need this information, you need to provide it. So subpoena is the only way that you give up the client's information. And I don't know this for a fact, but I've heard that there are some states that even a subpoena doesn't mean you have to give it up. But for the most part, if you're presented with a subpoena, according to the ACCT330, you're supposed to comply with it. But it has to be a valid subpoena. It cannot simply be, things that it can be a letter from a lawyer. A lawyer sent letters to everybody. We need information about this. Go get a subpoena. Go get a subpoena, and then you get that information. If not, then don't bother us. And things like letters from the IRS, things like that. Unless they get a subpoena, you don't turn over that information. So it has to be a valid subpoena. It has to come from a court. There has to be a real legal reason why people get it. It cannot just be somebody wants it. Even if they have a valid reason for it, they got to go to court, convince the court that it's a valid reason, and then they get the subpoena, and they can get access to the work papers, or part of the work papers, whatever they need. Okay. Hey, we're almost done. Retention of the work papers. This will take 2 seconds, maybe a little longer. ACCPA, 5 years. PCAOB, 7 years. Changing the work papers documentation after release. I'm gonna talk a little bit about this one. AICPA, 60 days. PCAOB, 45 days. Changing the work papers. This is sort of like what they might call cleaning up the work papers. And cleaning up the work papers means that a lot of times, for the most part, it means taking things out that maybe you don't need to have in there. I'll talk about that in a second. So cleaning up the work papers is sort of getting your ducks in a row for the work papers. After 65 days, you cannot remove anything from the work papers according to the ICPA. After 45 days from the PCAOB. For 45 days, you cannot remove anything from the working papers. You can always add things to the work papers. Oops. So for instance, as things change for the, as time goes on, things change for the client. Maybe they acquire a new subsidiary or something like that. You can always add things to the work papers. You cannot take anything away from the work papers though after 60 and 45 days. Okay, cleaning up the work papers. A lot of times things in the work papers are sort of dead ends. For instance, maybe you got a tip that somebody was embezzling money. You go check it out, and they're not embezzling money. It's just someone just talking, people talking in a lunchroom or something. So things like that, you don't want to have those hanging around on the work papers. First of all, they may be misleading to people who come along the next year and think that these are valid or whatever. But also, you don't want even the risk of that any information coming out that is slanderous, basically. To individuals, you looked into it, there was nothing to it. You generally don't keep that in the record. I was an internal auditor. I actually had someone tell me that there was a fraud going on, that the managers were selling equipment, keeping the money and all this stuff, and looked into it, and there was absolutely no truth to it. They said they saw the equipment being advertised on eBay, which is true. One of the ways they got rid of the stuff was they had an eBay account. The company had an eBay account, so actually there was an eBay account, but it wasn't going to the managers. All the money was tracked and brought in, this kind of stuff. And we're talking about like a few $100s a year and old shipping carts or something. But anyway, so I investigated this. And it came out to be nothing. So, we didn't do anything with it. And, my supervisor said, throw that away. Why have that in there? This accusation that is obviously false. So cleaning up the work papers is kind of getting your ducks in a row before it. Okay, I think that's it. Hey. So the next thing we're going to cover, as far as the chapters are concerned, is chapter 6, which is planning the audit. But the next thing we're going to cover in this class tonight is, I'm going to pull it up and we come back, we'll work on it. That's old stuff. Let's look at the new stuff. Monetary unit sampling. Okay. Oh boy, okay, this is gonna be a fun one. So let's say be back at, say 7 o'clock. All right. Okay. Monetary unit sampling. Yeah, physically did this like a month ago. And so far we've learned really great stuff about it. So you recall that we break everything up into intervals. And each one of those intervals is sort of like a mini sample. That you just take one item and say, okay, for that chunk of the sample, this one item is going to be for that entire chunk. So that's kind of the idea behind it. And there are some really, what is going on here? There are some really, sorry about that. There's some really great things about it. The great thing about it is, you recall that the intervals, that the more that someone cooks the books, the more likely it is they get caught. This is a really good method for overstatements. And the more someone overstates something, the more likely they get caught. And if they actually overstate it to the point where there's an item that's higher than the interval, it's 100% sure that it's going to get caught. So for overstatements, this sample is really good. It's also really good for picking the sample size and for picking the sample itself. It does those things very well. It's a lot quicker than classical sampling. And the fact that it picks the sample for you is also huge. So there are some really good big benefits to it. Now there's also some quirks to it though. And so that's what we're going to learn about today. We're going to hopefully get one all together here. Okay. So again, each of these chunks is a sample, kind of like a sample by itself. And we've picked one item to represent that entire sample. Finding the sample size is, I don't know if it's easy, but it's fairly quick. Even if we don't know what we're doing, we can probably figure it out in 5-10 minutes, which is way faster than classical sampling. Okay. So rules for monetary unit sampling. The incremental allowance is additional sampling error. And I'll talk about this a little more later. But it basically says that if you do find errors, that it's possible there are more errors. It's at least likely that there could be more errors in the sample itself. And it's only used when the book value of the misstated item is less than the interval. Okay. And we'll talk about how quirky that one is. Monetary unit sampling this is one that I always had trouble with. Is only used to detect overstatements. Understatements are ignored. And this is the one that as an auditor, you kind of feel bad about, because you're going through an audit, you find something that's wrong, you say, oh, well, look, this is wrong. Well, if it's an understatement, according to this method, it's not wrong. It's only looking for overstatements. And if it doesn't find an overstatement, everything's fine. So understatements are ignored, which again, as an auditor, when you do find something that's wrong, to ignore it is kind of goes against your grain. But so if the audit value is greater than the book value, we ignore it. And this is another quirk that we'll talk about. We'll talk about it down below a little more. If the misstated item has a book value that is equal to or larger than the interval, then the misstatement is the difference between the book value and the audit value, the actual misstatement. These items are not included in the incremental allowance that we are still going to talk about later. Okay, let's see how this works. Now, the first three here are pretty straightforward to kind of what we've been used to. And so we can work through these without, I don't think, any problem. All right, so we have an audit value. Divided by the book value. And we multiply that by the interval. Okay, so time for the calculator. So the first one, 14,000 divided by 20,000. Give our projected value. Okay, so this is 28,000. You may want to check that. Bring crazy numbers in here. Okay, so what would be the projected misstatement for this one? What's projected misstatement for that? So we're saying of this sample, that the sample of, I should say this chunk of it is 40,000. We're saying that it's the projected value of that is 28,000. So what's going to be the misstatement?
12,000.
Yep. So projected misstatement is going to be 12,000. And we're going to do the same thing for the next one here. Thousand. 8. Excuse me, 8,000. And this one, now in some of the textbooks, they'll say if there's a zero balance for the audit value, you got to figure out why. Quite honestly, you do that for all of sampling. But if this truly is zero, it's 0 over 17. So this would be 0, and the statement would be 40,000. Okay, the last three are wacky. What's strange about number 4?
The book value is lower than the audit value.
Yep, this is an understatement. Oh, that was not pretty good. Let me see if I can do something. I'm gonna merge them. Okay, this is an understatement. And understatements we ignore. This is the one that bugs me. As an auditor, you find something that's misstated, and you say, oh, no, that's not a problem. Rejected misstatement is 0. It's an understatement. We're not looking for those. Okay, these last two, kind of the same, fall in the same category. And that is, you'll notice that the book value is greater than the interval. This was 100% sure this was going to get caught. Okay, this is 100% sure it's going to get caught because it's greater than the, it's going to cover one interval. It might even cover two intervals. It's possible that it crosses two intervals, but it certainly caught one interval. And when this happens, we fall into this up here is the difference between the book value and the audit value, the actual misstatement. So we are not going to do our ratio here. We're going to take the actual misstatement. The book value is the audit is 11,000. And so that equals 33,000. So this thing is off by $33,000. Now, if you do multiply this out, you're going to come up with a lower number, 30,000. And notice that we know that this one is misstated by 33,000. The actual is 33,000. I can put actual in here. Okay, it worked. So this actual amount that it's actually off by, this is what we're going to put in here. This covers the entire interval. And again, if you were to multiply this out, you come out that this would be off by 30,000, which is less than we know it's off by. We know it's actually off by 33,000. And the one below here is the same thing. Then this one covers at least two intervals, maybe three. So this occurs when the book value is bigger than the interval. And this is when you're 100% sure that this thing is going to get picked because it's bigger than the interval. In this case, more than twice as big, but regardless, if it's bigger than the interval, then you take the actual amount that it's misstated by. So these last three are kind of wacky. Okay, now incremental allowance. Incremental allowance is when more bad things could happen in that interval. So for instance, this one here, though, let's take the first one, $20,000 of the book value. So there's another 20,000 still sitting in that interval. So could things be worse in that interval? Yeah. So it'll be included in the incremental allowance. Go to the next one. Could things be worse in this interval? Yeah, we covered it, this has $3,000. The interval is 40,000, so there's another, what, 37,000? So this could be worse too. And this one, 1,700 of that 40,000, and so could this be worse? Yeah. There's another 38,300 in there, so it could be worse. Number 4 isn't a problem, isn't a misstatement at all, so no. And you'll notice something about these two. The item is bigger than the interval. And so it's sort of like you've taken 100% of that chunk of the sample. You've audited this interval at 100%. It completely covers every dollar in this interval. And this interval too. They're completely covered. So could things be worse? No. These are not included in the incremental, and we'll talk about what that means later on. But so incremental allowance, these first 3 could be worse. The last, well, this one isn't a problem at all. This one doesn't really count. But these other 2, things could not be any worse in that sample. We've taken 100% sample of both of those. They could not be any worse. They are not included in the incremental. Okay, so we're going to add up all our misstatements here. Projected misstatement. $118,000. So this is our total misstatement. I should say projected misstatement actually. So our projected misstatement is 118,000. The book value was 800,000. Oops, no, it's fine. So 800,000 was the book value. So what would be the total projected value? Now remember, this projected value is going to be an overstatement. That's the only thing this method finds are overstatements. So this projected value, the projected misstatement, really is a projected overstatement of 118,000. So what would be the projected value of the, whatever these are, accounts receivable?
682,000.
Yeah, his question. Yeah. Yeah, so this is overstated by 118, so this would be the projected value. And even though we have this understatement here, we don't count it. This method isn't supposed to find it, and When it does find it, we ignore it. It's kind of like fishing, fishing and you catch a boot, you throw it, well, you'll throw it back in the water, but anyway, that's not what you're looking. All right. Now, we're gonna put this all together. Oh boy, okay. So this is a full problem, and by the way, this is kind of the format that in the past they've actually used on the CPA exam. They didn't have this stuff over here. I kind of added that, but they would have these columns. And so what we're going to do is find out our projected misstatement. And then we're going to introduce a couple new things here, just to make it more confusing. Okay, so we'll go through these. So first one. And 8,000 divided by 10,000. Okay, so the projected value of this, and again, these are only the ones that are that have misstatements. This isn't all of them. This is just. Oh, here's a question for you. How many items were in our sample? I'm going to put the answer in here for a second. 40,000. Oh, no. And the second one. What are we going to do with number 3?
It'll be 0.
Yep, very good. Yeah, this is an understatement. It's an understatement, so we don't do anything with it. We're saying it's 2,100. They're saying it's 2,000. We're saying that it's understated. We're not looking for understatements, so this is not a misstatement. You don't need to put this in, but it actually isn't a misstatement at all. So projected calculated projected misstatement is 40,000. I'm going to move it over so it's underneath that. Better. The projected misstatement is 10,000 plus 30,000 plus 0. What's that? Oh, I know what question is. So how many items were in our sample?
3.
More. So here's the interval, 50,000. And we split up that 6 million. It's a question I don't know the answer to. So how many items must, now, these are the ones that we found that had misstatements.
120.
That could be right. Again, asking questions I don't know the answer to. Yes, it's 120. So yeah, so this would be a sample size. Sample size would be 120. Now there's only 3 of them that were wrong, so, or actually, for this method, only 2 of them. All right, yeah, so 120 items, there's 3 of them, actually 2 of them that were wrong, and they're off by 40. Now, this is our best estimate. I'll put it over here. This is our best estimate of what the book is off by. Now, this is where it gets a little bit, well, it gets kind of back into the statistic-y kind of thing. I need a different camera. Need a doggy cam. Okay. Wait a minute. Okay. So it's sort of like this. So here is their sample, and they say that the funny here. So this is the book value is value is 6 million. Now, our best estimate is that this is our projected misstatement is that this is off by 40,000. And so this is the projected misstatement. Now, it's possible though, because this is a sample. It's possible at I think we're doing this at the 5% level, that this is off by even more because this is a sample. This isn't 100%. So it's possible that we have a bigger misstatement than just this. And this is what we call the upper limit. I'm going a little further here. So this is the upper limit. So it's possible this could be off by even more. All right. Sorry, I was just talking to myself there for a minute. So here's where that comes in, the basic precision and the incremental allowance. So first, we're going to start with basic precision. Now, if we go all the way down the very end of this thing, we find the formula for basic precision. Why your teacher does not have that up earlier in here, I don't know. I will be putting it in. So basic precision. Seems big. It was fun watching me learn how to use a computer. Okay, so basic precision, it equals our interval times reliability factor. Okay, so our interval is how much? Oh, come on, what's our interval?
$50,000.
Yep. 50,000. Now, for the hard part. Reliability factor. Coming down here, these are the reliability factors. Is it 5%? Let's give that a color, turquoise. Okay. Now, here's what the basic precision is all about. It's even if there were no misstatements, so if there were 0 misstatements, it's still possible this would be off by some amount, right? It's a sample. So you're going to take it at the 0 misstatements, and this is the risk of incorrect acceptance. 3. So this one is saying, okay, at 0 misstatements, even if you didn't have any misstatements, what could this be misstated by? And that comes out to 3 for the factor. Oops. And so this will equal our basic precision, 50,000 and 150,000. So basic precision. So going back to this thing. So what we're saying is that this could be off by another 150,000. And this is for the basic precision. This is if there were no errors, it could still be off by 150,000 more. Basic precision. Anyway, we'll color coordinate those. Make that orange. We'll make the projected misstatement pink. And we get one more. Okay, so we're saying that this could be up by, this is our best estimate is this up by 40,000. It's an overstatement of 40,000. But because this is a sample, it could be up by another 150,000, even if you didn't find any errors. Now, we know that we did find errors. And, these errors up here. And so these are going to go into what we call the incremental allowance. And that's not me barking. There are 2 dogs that are the size of hamsters. All right. So reliability factors, this is where it gets kind of wacky. I'll show you what it is. It's you almost tell I don't like doing this. Let me get rid of, oop, don't do that. All right. So we go to our reliability factors. So here's the reliability factors. Look at that label. It's labeled down below. Should be labeled here too. Okay. So the first thing we're going to do is take overstatement 1. Minus overstatement 0. Okay, so here is overstatement 0. And here's overstatement 1. $4.75 minus 3.00 minus 1. This will give us our first incremental factor. I think this is 0.75. And we'll do something with this in a moment. Okay, so we go to number 2. And overstatement number 2 is 6.3. Oh. Minus overstatement number 1. $4.75 minus 1 equals an incremental factor of something. .55. And you can kind of see where this is going. For statement 3. Minus overstatement 2. Equal some number. .46. So this is how we calculate the incremental factor. Now, you're probably wondering, like I am every time I teach this, why don't they just make an incremental factor table? It would be very easy to do off of this table, but and I've been tempted to do that myself. The only problem with that is I don't want, if this ever shows up on exam, you got to know how to use this reliability factors table. So I'm showing it to you using this table, although it would be very easy to make another table that just had the incremental factors on it. Okay, so getting back to our problem here. We are going to take these amounts and we're going to see if they are in the incremental allowance. In other words, could anything be worse? Okay, well, you'll notice that this one, the book value is less than the interval. So there's still plenty of that interval left if these could go wrong. Okay. Man, everything's happening right now. So this would be Same thing with this one, it's 4,000. The interval is 50,000. This one is not a misstatement, that wouldn't matter anyways, because it's 0, but. It's not a misstatement at all, so these two are misstatements. And because they're misstatements, it means that this could be off by more than. Just this up here, this kind of precision, if there weren't any misstatements. The fact that there are misstatements means that there could be bigger problems. So we're going to take the largest misstatement first. So which one is the largest? Oh, come on.
The 30,000 one?
Yeah, I'm sorry. Sorry about my phone and the dogs. Yes, 30,000. So the 30,000 is the first one. So that's what we're going to put in. So 75. Yeah. So the incremental allowance will be. What is that? 22,500. The second misstatement was, the second largest is 10,000. And 55 is 5,500. Oops, which one is? And the third one really isn't a misstatement at all. You could put 0 in here. You really don't need it. Actually, you don't even need this one at all. Get rid of it completely. There is no third mistake. Okay, so our incremental allowance, those two together would be the total. 27, no, 20, 28. So this would be $28,000. Okay, so 28,000, so that's where this would come in. I'm gonna insert a. So the incremental allowance is 28,000. So this could be up by another 28,000 because we had these misstatements that we found. Okay, so it's kind of like this. So there could be another 28,000. I don't know where to put it in here. So it could be another 28,000. This is the incremental allowance. And we'll make that blue. So all three of these together, the 40,000 plus the 150 plus the 28, this will be our upper limit. So I am going to need a little more room here. Okay, so I'm going to say, I'm going to copy this down. Give me 1 second here. Okay, so this will be our upper limit. All right, so let's see. 40 plus 50, was that 2? Is that 218? It's 218. 190, 20, I think that's 218. So this would be our upper limit. This is what it could possibly be off by. This is what we would use to determine if it is material or not. Now, finding that upper limit, you know, what is it, $6 million? It's a $6 million account. And it's off by 218,000, you know, so we could debate whether this is material or not. But you know, we should talk about the same number, and that this is our what it could be off by. Our best estimate is that it's off by 40,000. So this is our best estimate. However, because this is a sample, it could be off by as much as 218,000. So this is what we would use to determine whether this is materially misstated or not. And so this would look like this. You know, this the upper limit would be 218,000. And so this is the one that we would use to determine whether it's misstated, not the 40,000, even though this is our best estimate. It would be the 218,000 that it could possibly be off by. Oh, geez, you can't see it. All right, well, the number you can't see is 218, that's the upper limit. All right. So that's kind of what it, you know, this is our best estimate, this is what it could be off by. And so 218 is what we would use as our for our material misstatement, to see if that's material. And again, it's a judgment call. I think I told you guys this, and maybe I didn't, but they generally on the CPA exam, I don't think they've ever tested on judgment. You know, they'll ask what, you know, what's the calculate the upper limit on the statements, but they will not say, is that material or not, because that's a judgment call, and quite honestly, they well, I needed that number. Anyway, that, you know, it's not really something you can test on. Okay. Well, that's enough fun for tonight. So next week we'll pick up with the metro unit sampling, and then we'll start in on chapter 6. And I apologize for not having your tests graded. I'll have those in hopefully tonight. I'll get them all in. But anyway, yeah. So next week we'll finish. We'll go back into. We'll go into chapter 6, And we'll see, we'll still work on this. The monitoring unit sampling, it's kind of quirky, but for what it does, it can be very effective depending on what you're sampling. Any questions? Okay, have a good night. I'll see you guys in a week.
Good night,
Thank you,
Professor.
Professor. Have a good night.
Hi, Professor.
Okay.